For years, markets around the world have experienced tremendous growth. Stock indices have reached record highs, housing prices have soared, and easy credit has fueled consumer and corporate spending. But beneath this prosperity, there are signs of imbalance. First, consider asset valuations. Price-to-earnings ratios in the stock market are well above historical averages. In real estate, home prices have outpaced wage growth in many cities, making affordability a real concern. When assets become untethered from their underlying value, corrections often follow. Next, let's talk about debt. Both corporate and government debt have ballooned to unprecedented levels. Companies have taken on cheap loans to buy back shares and pay dividends, while governments have borrowed heavily to fund stimulus programs. This leverage amplifies returns in good times, but increases risk if economic conditions worsen. Meanwhile, global economic growth is showing signs of slowing. Geopolitical tensions, trade disputes, and the lingering effects of the pandemic have created instability. Inflation rates remain stubbornly high in many economies, forcing central banks to raise interest rates, which in turn makes borrowing more expensive. For years, central banks have propped up markets with low interest rates and asset purchases. Now, as they attempt to tighten policy to combat inflation, markets are reacting with increased volatility. The safety net investors have come to rely on is being pulled away, revealing underlying weaknesses. Let's not underestimate the role of sentiment. After years of gains, many investors are feeling invincible, reminiscent of previous bubbles. History shows that when confidence turns to fear, selling can quickly become a stampede, accelerating declines. So, what might a reset entail? We could see sharp corrections in equity and housing markets, a wave of corporate bankruptcies, and tighter credit conditions. This would impact not just investors, but also workers, retirees, and consumers alike. If we look back, market resets are not new. The dot-com crash in 2000, the housing crisis in 2008, each was preceded by periods of euphoria and excess. Each time, those who recognized the warning signs early were better prepared for the fallout. While no one can predict exactly when or how a market reset will occur, the evidence suggests that the risks are building. Now is the time for caution, diversification, and prudent financial planning. By understanding the forces at play, we can better navigate the uncertainties ahead.